Boeing and the leaders of its machinist union have reached a tentative deal to end the 5-week-long strike. The latest proposal includes 35% wage increases over the next 4 years. The union plans to vote on the deal this Wednesday, the same day Boeing is set to report its third quarter earnings. Joining us now to discuss, we've got Jason Gursky, Citi's managing director and lead analyst for aerospace and defense. Jason, great to speak with you. A big day coming up here for Boeing. How much faith are you putting in this deal being different from the one that we saw in September, where Boeing's workers were not pleased with the tentative agreement that the union leaders and Boeing executives had reached?
Well, it is different, right? The GWI, the gross wage increase, is higher. It sounds like it's got a little bit more for the machinists as it relates to, the opportunity to earn annual bonuses, as well as more money coming into the defined contribution plan. So we'll see where this lands, but it's a step, I guess, from their perspective, certainly in the right direction, and we'll find out on Wednesday whether it was a big enough step.
Jason, what do you think, just weighing the increase here in pay and what else it could be, what else is reportedly included in this package versus the optimism that we are getting some sort of deal? I guess, how are you evaluating, or how is that factoring in to your modeling here over the next several quarters?
Well, look, I mean, we've already incorporated in a pretty hefty increase into our model. So we'll just have to wait and see how this all shakes out. I think, let's, put this in context. I mean, the bill of materials on any aircraft, or the labor content on a bill of materials on any aircraft it's important, but it is not going to, have a profound impact on, the outlook for a company in any given quarter or year. We're watching it closely, but at this point, we'll have to wait and see. As I suggested, we've already modeled in a pretty hefty increase.
Well, Boeing is seeking, as you know, up to $35 billion more to boost their balance sheet moving forward. I'm just curious, at what point do investors see the amount of debt as an inflow on their balance sheet as something that no longer makes this a tenable stock to own?
Well, look, I think, we're going to hear from the company on Wednesday. This will be the company's first opportunity, the company's new CEO, the first opportunity to kind of lay out what he's learned here in his first 60, 75 days, whatever it is at this point, and discuss the plan going forward. What I expect to hear from him is that, he's going to get engaged in cost cutting as a way to increase the outlook for profitability. I suspect that they'll begin talking about product and customer pruning and trying to get out of businesses that don't have paths to profitability for them, again, as a way of increasing the structural profitability of the company, and then perhaps engaging in some divestments as a way to raise some liquidity to pay down debt, businesses that aren't core. The sacred cows, I think, at Boeing are commercial aircraft, fighter jets, and helicopters, and I suspect that everything else is likely to be evaluated for either potential wind down or sale as the company looks to turn itself around.
Jason, something that's getting a little bit more attention at this point is and going off the financial position of Boeing right now, is this doomsday scenario where you have the credit rating at risk of being downgraded. That will obviously raise borrowing costs. And then, of course, that leads to the discussion of what would happen next for Boeing. And there has been these ideas floated that it could raise the risk here of a default or potentially bankruptcy. Are those very much just overblown at this stage, given what we know?
Well, look, I don't think we're there anywhere close to that at this point, right? And we've got a company that has demonstrated an ability to generate significant levels of cash. Prior to the pandemic, the company generated a lot of cash year in and year out. The demand outlook here for the company is very robust. We have a backlog that stretches out well into the next decade. And what the company needs to figure out how to do is to better execute here in the near to medium term so that it can start generating some cash. It does have, a near-term issue with a stressed out balance sheet insofar as you have rating agencies that are threatening to downgrade to to non-investment grade. So I think, look, the focus is certainly going to be on the near term, protecting that investment grade. I think they'll do it through cost cutting, product pruning, and some divestments to get it done. But there are a lot of really solid assets here and a lot of cash generative power in this company.